Hello and welcome to our discussion on accounting. In this session, we will try to understand the difference between capital items and revenue items. For preparation of the financial statements, or rather even understanding the accounting, it is necessary to understand the distinction between the capital and revenue items. By the end of this session, you will be in a position to understand the distinction between capital goods and revenue goods, capital expenditure and revenue expenditure, capital receipts and revenue receipts, capital profits and revenue profit. So the distinction between capital and revenue items is the focus of this session. We know this is the accounting flow is the transactions flow into ledgers, the ledgers flow into trial balance, and then trial balance is normally converted into final accounts. But while doing this, the entire process is governed by the generally accepted accounting principle. One of the important principles is to understand the distinction between the capital items and revenue items. To recap the final accounts, the transactions are transferred to final accounts, which are called the statement of financial position, which is also called the balance sheet, the statement of financial performance, which is also called trading profit and loss account, and the statement of changes in a cash in hand, which is the cash flow statement. But these transactions is where the distinction of capital and revenue items is necessary to be identified, because depending on the nature, they will affect the financial statement. For example, the capital items will be transferred to the balance sheet. The revenue items are transferred to the income, profit and loss account. Capital and revenue items may affect the cash flow statement. So we can see the distinction between capital and revenue is important as a prelude to understand the treatment on their financial statements. Let us take the expenditure. The expenditure may be capital in nature or revenue in nature. The capital expenditure is transferred to the balance sheet, and the revenue expenditure is transferred to the trading profit and loss account. So what is this capital expenditure? The expenditure which is incurred to acquire or purchase any long-lived assets. In other words, an expenditure which creates the asset, which results in the acquisition of asset, the benefit of which is derived for more than one accounting period, and that increases the earning capacity of the business. So there are different ways in which capital expenditure can be defined. Either it may result in acquisition of an asset, or any expense which will be derived for more than one accounting period, or that increases the earning capacity of the existing assets too. The purchase of fixed assets such as land, building, plant, machinery are the examples of popular capital expenditure. Some major repairs and replacements of an existing assets will also be called capital expenditure. Expenditure incurred in improvement of fixed assets. For example, increasing the number of seats in a coaching center will be treated as a capex because it results in increase in the income. So capital expenditure by default, the benefit continues for more than 1 year. It's something which results in acquisition of asset. On the other hand, revenue expenditure is the expenditure which is incurred for day-to-day operations of the business, and the benefit of which is derived in the current year only. So unlike the capital expenditure, the revenue expenditure, the benefits get expired in the year one itself, in the year in which it is incurred. For example, buying vegetables is a revenue expense for the vegetable vendor, but buying the weighing machine is a capital expenditure for the vendor, because the weighing machine will give him benefit for more than one accounting period. It is an asset, and this results in the benefit of which will continue for more than 1 year. For a cell phone trader, buying cell phone and SIM cards is a revenue expense. Buying the showcase to display the cell phones is a capital expenses. So as we mentioned, capital expenditure is shown in the balance sheet and revenue expense is shown in the P&L account or the profit and loss account. Let us take an example and observe the effect. Purchase plant. So the journal entry for that is plant account debited to cash account. Plant, acquired plant, and outflow of cash. In the balance sheet, the plant will be shown as an asset, and in the cash flow statement, the plant payment for the plant is shown as an outflow of cash. No income, no expense, because this is capital expenditure in nature. But let us see this one. Rent paid. Rent paid is an outflow of cash. But rent paid is not an asset, but it is a rent for the period. So the entire rent is shown in the income statement or the profit and loss account. So unlike the plant, which is fully transferred to the balance sheet, the rent is fully transferred to the income statement. This is a typical revenue expenses, and this is a typical capital expenditure. Now let us see another expense called deferred revenue expenditure. It is by default is a revenue expenditure, the benefit of which, however, is available for more than 1 year. Such expenditures are transferred over a period of time to the income statement. Let me give a small example. Suppose advertisement for the year by default is a revenue expenditure. But if advertisement for launching a new product, starting a new business, we expect that the benefit of that advertisement will continue for more than 1 year. So therefore, the entire advertisement will not be treated as an revenue expenses. For example, advertisement for launching a new product is 30,000. The payment of cash is 30,000. Outflow of cash is 30,000. But we can see that suppose we assume that the benefit of this is for a period of 3 years. This is a management decision. If it is for 3 years, we assume that the expense for the year is 10,000 and the balance will be shown as an asset. Let me explain once again. So the payment is 30,000, but the benefit of 30,000, 10,000 of that, 1/3 of that is assumed to be expired in 1 year, so it is an expense. The balance 20,000, it will accrue, the benefit will accrue in the next few years, so it will continue to appear on the balance sheet as an asset or unexpired benefit. So the revenue expenses like rent is fully shown in the income statement, the plant fully shown on the assets, whereas the deferred revenue is partly shown in the income statement and partly shown in the balance sheet. Another interesting item is called capitalized expenditure. This is a revenue expenditure that are incidental to the purchase of the capital asset. So any expense required to bring an asset to working condition can be capitalized. That means can be included into the cost of the asset. For example, wages for installing the plant and machinery. So in this case also, for example, I purchase a plant of 20,000 and the transportation is 3,000. So the payment is 20,000 and 3,000. But should I treat anything as an expense? It depends on the decision whether I'll capitalize this or this transport cost or not. In this case, we are assuming that entire transport cost is capitalized. So capitalization is a process of including transportation, which is normally treated as a revenue expenses, into the cost of the plant. So the cost of the plant will be now 23,000, is the money paid to purchase the plant and also money paid to bring the plant to the company's godown. So capitalization is a capitalized expenditure. Deferred revenue expenditure, partly transferred to the income statement, partly transferred to the income balance sheet. The revenue expenditure fully transferred to the income statement, and capital expenditure fully transferred to the balance sheet. So therefore, understanding the distinction between the capital and revenue is an important part of preparing the profit and loss account. Thank you very much.